The business that insurers do not voluntarily assume is called the residual market. Residual markets may also be called shared because the profits and losses of each type of residual market are shared by all insurers in the state selling that type of insurance, or involuntary because insurers do not choose to underwrite the business in contrast to the regular voluntary market. Residual market programs are rarely self-sufficient, where the rates charged to high-risk policyholders are too low to support the program's operation, generally assessed to make up the difference. These additional costs are typically passed on all insurance consumers. However, in a few states, insurers are not able to recoup their residual market losses, and political pressure prevents rates from rising to the level they should be. Actually, the number of drivers and properties insured in the residual market, lawmakers and regulators change laws or address availability, rate, adequacy, and other factors that influence underwriting decisions. The automobile residual market, the first of the residual market mechanism for automobile coverage, was established in New Hampshire in 1938 as states began to pass laws requiring drivers to furnish proof of insurance. Having auto liability insurance become a for driving a car today. All 50 states and the District of Columbia use one of your system to guarantee that auto insurance is available to those who need it. All four systems are commonly known as assigned risk plans, although the term technically applies only to the first type of plan, where each insurer is required to assume its share of residual market policyholder or risk. The term risk is used in the insurance industry to denote the policyholder or property insured as well as the chance of loss. Commercial auto insurance is also available through the residual market. Automobile insurance plans, the assigned risk plan, the most common. Hmm. Hmm. Columbia generally is administered through an office created representing insurance companies license. Automobile insurance plan, the assigned risk plan, the most common type currently found in 42 states and the District of Columbia, generally is administered through an office created or supported by the state and governed by a board representing insurance companies licensed in the state. When agents or company representatives are unable to obtain auto insurance for an applicant in the voluntary market, they submit the application to the assigned risk plan office. These applications are distributed randomly by the automobile insurance plan to all insurance companies that offer automobile liability coverage in the state in proportion to the amount of their voluntary business. Thus, if on a given day the plan receives 100 applications from agents around the state, a company with 10% of the state's regular private passenger automobile insurance business will be assigned 10 of those applicants and will be responsible for all associated losses. Assigned risk policies usually are more restricted in the coverage they can provide and have lower limits than voluntary market policies. In addition, premium for assigned risk policies usually are significantly higher, although not always sufficiently high enough to cover the increased cost of insuring high-risk drivers. Joint Underwriting Association automobile found in 4 states. Automobile Jobs Underwriting Association automobile found in 4 states, Florida, Hawaii, and Missouri are state-mandated pooling mechanisms through which all companies doing business in the state share the premiums of business outside the voluntary market as well as the profits or losses and expenses incurred. To simplify the policyholder distribution process, insurance agents and company representatives are generally assigned one of several serving carriers. They submit applications so that company with then issues the policy in migration. However, agents submit applications directly to the office which then distributes them to the servicing carriers. Coverage offered by generally are the same as those offered in the voluntary market, but the limits may be lower. Although rates may be higher than in the voluntary market, they may not be sufficient for the joy to be self-sustaining. State statutes setting up the judge generally permit it to be recoup losses by surcharging policyholder or deducting losses from state premium taxes. Jobs for commercial insurance coverage such as medical malpractice and liquor liability may operate somewhat differently in some states. See below. Reinsurance facilities. Reinsurance facilities exist in North Carolina, New Hampshire, and Massachusetts. In beginning in April 2008, the reinsurance facility, which is known as Commonwealth Automobile Insurance or CAR, began disbanding over a 3-year period as the new managed competition regulations take effect. An automobile insurance facility in an unincorporated non-profit entity through which auto insurance provides coverage and service claims after issuing a policy, and the insurer devises whether to handle the policy. A part of its regular voluntary business of transfer it to the reinsurance facility or pool and ensure it's permitted to transfer or see to the pool a percentage of its policy's premium for this portion of businesses are sent to the pool, and companies bill the pool for claims, payments, and expenses. Profits or losses are shared by all auto insurers licensed in the state. State funds. One state, Maryland, has a residual market mechanism for auto insurance which is administered by the state. It was created in 1973. Private insurers do not participate directly in the Maryland Automobile Insurance Fund but are required by law to subsidize any loss from the operation, with the cost being charged back against their own policyholders in years that the fund has a loss. All Maryland insured drivers, including MIP drivers, help offset the deficit through an assessment mechanism. Size of the auto insurance market. Together, residual marketed programs insured about 1.97 million cars in 2007, about 1.06% of the total market, and a 9.0% drop from 2006, according to the Automobile Insurance Plans Service Office, which tracks such data. In 1999, the residual market served 6.3% of the total market. In 2007, in a major change from much of the 1990s, only one state, North Carolina, had more than a million cars insured through the residual market. At 1.5 million, the pool insured more than 21.6% of the state total insured vehicles. In South Carolina, which enacted sweeping reforms in 1998, The residual market dropped from 38% of all insured cars in 1996 to close the zero in 2007.